why are they interested in investing in your system? So we'll talk a little bit about that. Why you may be motivated to let them invest in your system, and what is your role in that? What they can do for you, and what they can't do for you, because there are some things they can't do for you, and then questions and answers at the end. So like I said earlier, I encourage you to submit questions as we go along. You don't have to wait till the end, and we'll try to get to as many as we can. And then also the last slide will have my contact information. If you are too shy to ask a question, or you think of something later on, feel free to drop me a note, and I'm happy to answer any questions you might submit to me. So a couple things to keep in mind during the webinar. I think maybe Savannah mentioned, but if not, I'll mention it. I spent 35 years working for an investor-owned utility, a large investor-owned water and wastewater utility, and so that's my background. And I've been with the EFC for 6 or 8 months now. But we're going to talk about a bunch of publicly traded companies, and I just want to make sure people understand that I'm not here to give investment advice or to endorse one company over another. Also, things to keep in mind are progressive utilities, whether you're public or private, seller or acquirer, O&M company or otherwise. You need to have flexibility in your model and make those adjustments as we go along. Again, one solution does not fit all. And then finally, and again, might be a sort of self-evident, but there are good and bad actors in every profession, right? So if you're in this industry, you'll see stories about bad experiences when it comes to private water and wastewater companies, and you might see some really good experiences when it comes to water and wastewater utilities. And so I think it's important to keep an open mind and judge for yourself as you go along, and weigh both the good and the bad that you hear. So again, one of my favorite lines is private companies are just another tool in the toolbox. A lot of us, in my private life, there was a lot of investing in infrastructure. If you're a public company or even if you're a private company, there's just a lot of investing that needs to be done. A lot of talk about consolidation and partnerships. We're actually going to talk a little bit about partnerships towards the end. But just think of the role private companies might play in your system as just another tool in the toolbox, not a solution for everybody. So let's talk a little bit about who these private companies, water and sewer companies are. I'm gonna probably say water companies. It's water and sewer. Most of these companies do both. Maybe all of them do both. And in true water industry fashion, I think of it in buckets, right? So I think of it as 3 buckets: publicly traded, privately held, and foreign owned. And unless you've sort of lived in the world of investor-owned utilities or private systems, you might not know about all the different kinds of companies that exist out there. So we'll give you a couple examples, or a few examples of each of them. Publicly traded is just that, right? These are companies that are publicly traded, have shareholders, and exist on a stock exchange somewhere. The first one is American Water. It's one of the largest publicly traded water and wastewater companies in the United States. It's actually traded on the New York Stock Exchange, and they own and operate systems in a multitude of states across the country. You can go to their website and kind of see where their footprint is. The second is a company called Aqua America. Again, one of the largest publicly traded water and wastewater companies in the United States. They primarily own systems, so they own assets, which is a little bit different than American. American owns and operates and does some other things, whereas Aqua is more of an ownership model. A company called Middlesex Water. which is a little smaller than the other two. They actually operate in New Jersey, Pennsylvania, and Delaware, and they're traded on the NASDAQ. And so they do a little bit different even than the first two. They own systems. They do operations and maintenance for some systems, and they do some building of infrastructure, build, own, operate, transfer, and we're going to talk a little bit about what is commonly referred to as a boot model later on, but they do a little bit of everything. And then the final one is American States Water Company, and they primarily own systems in Northern California, but one of the things they do that the others don't do as much is they're a contract service provider for utility systems on military bases across the United States. And I think they're rather unique that they've kind of found that niche. And there's other companies that do it, but American States does it a lot. And they like I said, operate across the United States. So they act as the operator for these systems on different military bases across the United States. Again, they're traded on the New York Stock Exchange. And this is just 4 of these publicly traded companies. There's other companies out there that are publicly traded also. So then the second bucket is a bucket that I like to refer to as privately held. So this is closely held, for lack of a better term, companies that might be owned by a single entity. Well, they are owned by a single entity. And I've given you 3 examples of those. The first is a company called Plurus, and they're actually owned by a family in Texas, and their headquarters is in Texas, but they own systems in North Carolina, Florida, and Alabama, and again, they're privately held system. U.S. Water Services Corp., and there's a bunch of companies that sort of have that U.S. water thing in it, but this is U.S. Water Services Corp. They're based in Florida, and they're primarily an operations company. They operate systems in 60 counties in Florida, and they also provide services such as engineering and water residuals and wastewater residuals hauling in other states. And they're, like I said, privately owned by a small group of people. And then Southwest Water, they own and operate systems in Alabama, California, Oklahoma, Oregon, South Carolina, and Texas. And they're owned by J.P. Morgan Asset Management, which is the J.P. Morgan that many of us know as an investment company. And the asset management is primarily a pension fund vehicle. So it's money that J.P. Morgan has for investing for pension funds, and they've purchased Southwest Water and operate those systems. Some that I didn't put up there there's a lot of small privately held companies in all the states across the United States, right? So they could be single communities. Maybe the developer put them in and he has retained them as a utility, or maybe another individual just owns a single system. That's an example of some of the privately held ones that are very small systems located across the United States. And then foreign owned, and I'm not making any judgments here. I'm just pointing out the ownership models here, right? So I give you 4 examples of those. The first is a company called Utilities, Inc. They are currently owned by a company called Corix, which is owned by British Columbia Investment Management Corporation. And again, they're primarily a Canadian pension fund investment vehicle, and they operate in 15 states. The company EPCOR is another Canadian company, and they own and operate water and wastewater systems in primarily the southeastern United States and Canada. And a little bit of difference with them is they are wholly owned by the city of Edmonton in Canada, but they have ventured into the United States, and they have bought some systems in southeastern United States as an investment vehicle. again, primarily for pension purposes. And then two really big worldwide companies, Veolia and Suez. They're both French companies and owned by a French principal company, but they have worldwide operations and maintenance capabilities, and they operate in the United States as well. They're all, any of us who have dealt with any of these companies, they're all good companies, and they all bring different talents to the table. It's just an example of sort of the three buckets of ownership. So how does a private system work? And this is where the math comes in, and we're not going to spend a ton of time doing the math. I'm just going to kind of point out some things to it. And primarily, I'm going to talk about a rate-based model of asset ownership. And think of that as the private company owning pipes, pumps, wells, customer touch. They own it all. They act as a public company, except that they are privately held and in some cases publicly traded. But this is going to be sort of the very low-level rate-based model. So rate base, what is rate base? So think of rate base as the total investment that the customers are gaining benefit of currently. It does not include contributed property, which is an important thing to remember, right? Contributed property is just that. That's assets that somebody has given to the utility. And so you can see sort of the math there. Starts off with plant and service, and then you deduct out depreciation, which is, of course, is an accounting practice, is the long-term pay or long-term payment against the capital asset. And it's, again, just an accounting point of view. The asset, even though it might have been fully depreciated, it very likely could still be in service, but the depreciation is calculated in there. And then in most states, and this is sort of generic, right? So your state might be a little bit different. The utility is allowed to earn on inventories, a certain amount of inventory supplies and cash working capital. And then there's a deduction for deferred income taxes. And again, this is the deferred income taxes is the difference in income recognition between tax laws and accounting methods. And it gets you to a total rate base. So we start off at 1,200 and end up at 1,000. So in the private sector, in the private world, there's a lot of discussion and sort of science or art when it comes to cost of capital. And cost of capital in all instances, whether you're a public or a private company, is what does it cost for you to borrow money from somebody, right? And as simple as it is in a private company, it's usually a mix of debt and equity. And debt is just that. It's money you owe somebody. It's either a bank. In some instances, it might be bonds. In some instances, it might be the state if you're using SRF money. And so that's sort of what debt is. And then equity is shareholder equity. So this is what the shareholders of the company have invested in this company based on what they purchased their stock for. And so it gets calculated into a weighted cost, and you can see the math there. And again, these numbers are just numbers in this case. I will tell you that my experience is that the debt number is at 10% right now, is probably closer to 5% for a lot of the companies that are out there operating. And the equity number is not 14, it's maybe closer to 10%. But again, these numbers are different in every state. They're different for every company, and we'll talk a little bit about how that is. Okay, and so this is simply the calculation of a rate increase in this case. And so what we did was we calculated the revenue requirement, right? The revenue requirement is 660, or I'm sorry, the revenue requirement in this case is 677. The existing operating revenues is 660. And so in this case, there's operating expenses other than income taxes, and these are the expenses that you would expect for any utility, right? So electric, labor, chemicals, that kind of thing. Not pipe and plant, right? But this is variable operating expenses. And then in the private world, this is really scrutinized by the regulators. The utility commissions and the public advocate go through operating expenses with a fine-tooth comb to make sure that it's prudent and that there isn't, there isn't a need for trimming what the company is asking for. And then the interest expense required is that cost of capital we were talking about, and then the equity return required. So again, this is what your shareholders in a private company are getting have the opportunity to earn. So in this case, it's 70, and then it's grossed up for the income tax in this case. And I will tell you there's a typo there. That shouldn't be $0.6. That should be divided by 0.6. And that gets you to that 117, which is the equity return plus the income tax. And then, of course, you add those two together, or you add that all up, and you end up with a required revenue of 677. So in this case, the utility is due the opportunity for a $17 increase in its revenue requirement. So the simple way to say this is full cost accounting. So once the revenue requirement is set, then in all instances they go to rate design. So need drives the rates, not sort of backwards. So why do these private companies use this rate-based model? It's highly used across many states. And there's both pluses and minuses to it, and some of the pluses might be considered minuses by some people and vice versa. But simply from a company's perspective, it provides them a mechanism for a return on shareholders' equity for prudent investments that benefit the customer. And you notice how I say that. So that prudent investments, again, scrutinized by the utility commission and the consumer advocate and others. So not overbuilt plant, not gold plating a plant, that kind of thing. And it has to benefit the customers. So it has to benefit. In North Carolina, they would say it benefits the using and consuming public. It can't be something held for future use. There's other ways of that, how that's treated, but it has to benefit the customers today to ask the customers to pay for it through rates. It also, just by the nature of it, incentivizes companies to make the needed investments in infrastructure. So when I get asked how do utility companies work, I say, and this is rather simplistic, but they are investment companies that get a return based on sales of water. And so they're looking for places to invest money, and in this case, it's pipes and pumps and services and that kind of thing. This same model works in the electric business. Of course, it's very complex in both, but the electric businesses, a lot of them, if they're fully regulated, same deal. They're getting return on their investments, whether it's nuclear plants or poles and wires. So same kind of model works for most of these utility models. It also allows for a long-term view of return, right? There's not big peaks and valleys, and it's sort of steady eddy. So it's a long-term view, and I think you can kind of see that when you look at some of those private holders, especially, right? They're pension funds that are in for the long haul. They're not looking for something necessarily that's going to keep them up at night, like something that's going to go up and down. They're looking for the long-term return and a pretty steady return. And then by definition, and if you've been on any of the EFC calls, especially with some of my colleagues here at UNC, this model charges full cost of service. So if it's an expense that's prudent and it's an investment that was made that benefits the customer, then that's how a rate-based model works, right? Again, no guarantees that the company makes their return. It's an opportunity to make a return, but it's definitely a full cost of service. And then maybe some of the minuses are that, you know, between rate cases, there has to be a dialogue between the financial regulators, which are the utility commissions and in some instances the public advocates, so that there shouldn't be surprises during a rate case filing, right? There needs to be a dialogue between the private companies, whether you're publicly traded or private or foreign owned, whatever they are. There needs to be that dialogue between those individuals. The model can be kind of somewhat foreign to people because it's just kind of different, right? If you live in the sort of the normal accounting world, the rate-based return model can be a little bit different, so it's a little hard to understand. And then the lag in time between investments. So a company could make an investment today and not ask for a return until 2 years from now. So there's a lag in there, and there's some mechanisms in place in some states to sort of minimize that lag. And so the rate-based model is one of the widest used models across the nation. But there are a couple other models I'm going to touch on. One is sort of the operating margin, which is basically a cost-plus model. And so the difference is that it's your operating expenses plus a percentage that you get as a return. And you know, it has a depreciation, in many cases has a depreciation component in there and a cost of capital component in there, but it really is, it doesn't incentivize the company to invest in infrastructure like a rate-based model does. Contract O&M, which is contract operations and maintenance, which a lot of systems have been going to, that basically moves the in-house expense of having in-house labor and that kind of thing and other expenses to an external expense. And in some cases, it might move some of that risk across to the private company. And in some cases, and again, I tried to choose my words carefully, it could cost less, or it could defer costs, or it could have cost containment, depending on how you look at it in the contract O&M. And then one of the sort of models, and this is less of a utility model, but sort of a public-private partnership sort of model, is the build, own, operate, transfer, commonly referred to as a BOOT. And so it's just that, right? The private company comes in and builds, for example, a plant. They own the plant, they operate the plant, and in many cases there's a mechanism for it to transfer back to the public system at some point in the future. It's touted as potentially having a shorter construction timeline, and in some cases the private companies will provide financing. So they might bring their own money to the table, and in some cases they'll use public money. So, you know, utility infrastructure, whether it's public or private, publicly traded, privately owned, or foreign-owned companies, it's still something that we all have to be cognizant of, and it's everybody's issue. And no matter who makes the investment, whether it's public or private, somebody's paying for it, right? Whether it's through rates or through taxes or however it's done. But in the private model, it's a rate issue, right? It's a full cost of service issue. So why are these private companies interested in investing in your system? So, and you can see that there's been some newer participation. EPCOR, for example, only entered into the United States, I don't know, in the last 10 years maybe. Maybe it's been a little bit longer, but there are some new players that come in. And part of it is that there's a large pool of potential partners out there, right? There's about 50,000 community water systems in the United States, and so there's a lot of opportunity for investment to be made. Clearly, there's a documented need for capital investments. A lot of discussion about that. Those investors are looking for a steady, predictable revenue stream. Again, pension funds are a big user of utilities because they're looking for that steady, predictable revenue stream. A number of those private systems that are investor-owned have dividends that they pay out, so they're looking for a steady, predictable revenue stream, a relatively predictable revenue stream, so that they can pay those dividends. And then probably other than asset purchase, which is primarily what I've been talking about today, the second largest involvement of private companies is probably the O&M partnerships. And, it allows a private company to gain entry into a community. So they may use it as a vehicle that they can come in there and build some trust with the community with the idea that maybe in the future they would purchase the asset, or they might just be doing it as a margin business, right? Or there might be other ways that they get paid during the partnership. And so it also spreads some fixed costs over a larger customer base, so it spreads their cost over a larger customer base. And in many cases, they have a purchasing pool that's larger than the company that they end up doing O&M services for. So if you're a public company, why might you be motivated to let a private system invest in your system? And it's a good question. And again, we'll go back, it's not on the slide, but go back to the beginning. It's a tool in the toolbox. It's not the right fit for everybody, but it's something to be considered if you feel the need to. So again, the value proposition of a private system, they're interested in paying a fair value for the asset. And so I'm going to kind of go off script a little bit and talk a little bit about fair value. So fair value is a little bit different than rate base, right? Rate base is a prescribed accounting method that has, it's the asset that benefits the public today. In fair value, it's just that. It's the value of the system. And there's different ways that it gets calculated, sometimes by, an appraiser might come in and do that, an engineer might do it. They might look at original cost, less depreciation, that kind of thing. But there's some states that have recognized that the public utility, the government-owned system, for lack of better terms, because of their accounting methods or the way that they grew, the rate base might not be very high, or might not represent the true fair value of the system. So some states, for example, Illinois, Pennsylvania, and it was actually proposed in North Carolina this last year, have tried to address that in some fair value changes to the rules. And then investors, investors in private systems want to see their systems done, the operations done properly. Utility commissions typically penalize bad operators. And so when I use the term penalize, maybe they don't allow a return on equity that the utility, the private system might ask for, or much less than what they ask for, or they might trim them in other ways or they might give them some requirements in the rate order for reporting and other things. So the private systems certainly want to see their investments operated properly, and so they have a motivation to do that. And then finally, investors, the private systems, the owners of the private systems, they have a strong desire to see your system grow and prosper. It's not unusual for a private system to be involved in, as a resource, if nothing else, in economic development in communities that they serve. They're interested in seeing your community be strong and vibrant and continue to grow. So a little sort of reality check. How does this all work, right? Water and wastewater is touted to be the most capital-intensive industry. So there's a lot of need for capital, whether it's public capital or private capital. There's a big fixed cost when it comes to operating a water and wastewater system. In some cases, there's been a need for more reliable sources of supply. Parts of the country have gone through some pretty severe droughts over recent years, and that sort of demonstrated that. The one that we see a lot, I do a lot of work with small systems across the country, declining populations in the small systems and loss of significant customers. And coupled with that the industry itself has seen just a reduction in gallons billed. Customers are learning that they don't need to irrigate as much, or they've put in low flow fixtures or whatever the case might be. And so there's a lot of pressure because of all those issues. Water as opposed to electricity is sort of out of sight and out of mind. People get up in the middle of the night, turn on the spigot, and expect it to be there, but you can't look outside and see the poles and wires like you can with electricity. So people need, there's an education process there to make sure people understand the need for this investment. And the reality is that private companies have access to capital and need these new investment opportunities. So they're looking to grow. Every last one of them wants to grow without exception. So they're looking for opportunities across the country. One bullet I didn't put there that we're also seeing, as Savannah said, we do a lot of work through EFCM on funding, is that public money sources are getting to be few and far, or tightening up, and the grant opportunities are getting to be less and less also. Some other motivating factors, if you're a public utility or a system that might be interested in entertaining a relationship with a private utility, is that there are some economies of scale when it comes to a larger customer base, and it doesn't necessarily have to be connected. In North Carolina, the largest private utility in North Carolina operates 500 systems across the state, but they're not connected, right? They're all over the state, but they have the economy of scale because they share labor and they share, oversight. There's only one accounting department. There's not 500, that kind of thing. Expenses will continue to increase, so any way you can do to minimize them, and maybe going to a larger company would help. Changing environmental regulations, that drive the need for more capital investment. There was a webinar not long ago that talked about, the changing of the sort of the demographics of labor within our industry. There's a lot of gray hair in this industry, and so companies that are larger can kind of spread that risk of losing that institutional knowledge over a broader base. If you decide that a private company is, whether it's O&M or asset sale or something else, is part of the mixture, it allows then the public entity to sort of focus back on its core competencies, whatever that might be, right? Police, fire, roads, something like that. And I think it's worth saying that in some instances that there's just not the political will to raise rates. Full cost of service, it is what it is, for lack of better terms, but sometimes there's a lack of political will to raise rates. So what can a private company do for you? Again, they can help you monetize your system to help you with other priorities. In some instances, they can help, you can monetize an asset to satisfy unfunded obligations. It's sort of a code word saying unfunded pension in some states. That's a big issue across many states. They bring their own financing, so it frees up debt capacity for some of the sellers. The large companies have great technical expertise. Every last one of them have great expertise. If it didn't happen in the state that they're serving today, it happened in another state that they're serving, and they share that expertise. There is true transparency in a regulated model. So when they file a rate case, that's full open books to the regulators, other than confidential information such as salaries and that kind of thing. It's pretty much available to the public or anybody else to look at the documents. So expenses, capital investment, all that. It's pretty much an open book kind of company. And again, a little bit of a broken record, but it spreads that fixed costs over a larger base. What they can't do for you, and I think it's important to remember that they can't. There's things that they just can't do. And at some point, their pricing has to reflect the full cost of service. That doesn't mean that they might not come in with a initial lower than full cost of service and take a little loss against their return on equity. But at some point, they have to do full cost of service. They have a fiduciary duty, especially the public companies, investor-owned, to do that. Guarantees on how they're going to run their business. They have a business to run. It will be different than what is being run today, and that's just the nature of the beast. So there has to be an open mind when it comes to that. Again, growth is part of the business model. So if growth is not part of the public company's business model, then that has to be a discussion. And they will take the risk off the table, but there at some point has to be an ability to recover costs. Again, I view total asset purchase as a partnership, right? If you're talking to a private company and they don't discuss the idea of being a partner in your community, then you need to ask why they're not doing that, right? Whether they are, if they own the assets in your town or in your system, they need to be a partner in your community. I think that all the great companies are doing more and more of that, and so I think that's a question worth asking for. You have to remember that there is a profit in there, right? In my previous life, when I worked for a private utility, I made it clear that we were here to make a profit. We were here to make a reasonable profit. We weren't looking to gouge anybody. We had responsibilities to our customers, and if we took care of our customers, our shareholders got the return they were expecting. But there is a profit involved in these instances. And then, again, keep in mind regulatory oversight provides protections for the customer. And I'm going to touch on some of these that are a little bit different than the utility model. So a concession agreement, this is where the public entity pays a partner a monthly ops fee. Basically it moves some of that risk over to the private company. The profit is made on a margin, so cost plus. Sometimes there's a shared savings component. In some instances, the concession company makes investments in the system, so there might be a way that they can make those investments and get their return. And then in some cases, there's a combination of all the above. And there's been a lot of big concession agreements in the last few years that you can if you search on concession agreements, water systems, you can find them all. And some of them are straight shared savings maybe, or on the margin. You see a lot. Some of them are a mixture of all of these. And then there's some hybrids that you need to think about when it comes to potential partnerships. And these might include private companies or public companies or a combination of both, right? A joint authority is an example of a partnership. Two separate systems might come together and form a joint authority, and there might be a participation by a private system. For example, in an O&M setting, there might be a place for a private company. And then I know in an asset purchase that I was involved in years ago, there was what I like to call combined ownership. So this was the selling company was a governmental unit. They wanted to make sure that if they got to monetize the asset, that money didn't get lost over time. So they wanted an equity or annuities type payment. So the private company ended up buying the assets, but they actually leased the real estate on 2 long-term leases, and it allows the purchaser to pay out over time. So it actually helps the ratepayers because it's an operating expense that gets paid out over time, and it provides that annuity to the seller. I thought that was kind of a unique thing. And then we talked a little bit about the boot, right? The build, own, operate, transfer kind of model. So what can you do to prepare for potential partnerships? And could be any of the partnerships we discussed. The publicly owned systems, good books are key, right? So keep accurate books, and it's important to establish rate base if there's no fair value component in your state, that you keep track of contributed property. So if a developer comes in and puts in a distribution system and then gives it to you, that needs to be considered in the transaction. And so accurate books are important. Again, be realistic about what you want out of a partnership. I think it goes without saying that if the deal sounds too good to be true, it probably is, and you need to think about that, and then understand the other partner's motivations, whatever they might be. And then private company, you need to be sensitive to the public-owned system's concerns, right? You might think you know what their concerns are, and they might not be what you're thinking at all. Rates are typically a concern. I think you need to be honest with whoever you're partnering with as to where you see rates over a period of time. Understand that this relationship is forever, right? These are not relationships that break up very often, and when they break up, they're usually not good. So they are considered a forever. The gestation period of a deal is typically long, right? A public system might, in some cases, have to go to referendum. There might be other things, but these are not deals that happen overnight. There's a change in leadership. In other words, if you go through a political cycle, there might actually slow it down some more. And again, flexibility. One model does not fit all. And so a few final thoughts, and then we're going to take some questions. And so if you haven't typed in your questions, please do so now so that we have a good group of questions. Again, private companies should be a consideration in your toolbox, right? They don't fix everything, they don't fit all, but they should be something that you look at and with an open mind and with a flexible view as to if they have a role in your system. I think it's important to remember that, in most cases, in all cases, in one fashion or another, private companies bring their own money to the deal. So those big companies, they typically borrow at the corporate level. So they borrow across a large platform and then push that savings down to the local state or the local system. So that's the debt portion of it. And of course, they have the equity portion also that brings money to the table. They're there to invest. So they have money, and they know where to get the money if they don't have it readily available. Again, I said it in the last slide, assume the partnerships are forever. Unless you have a build, own, operate, transfer kind of deal, or if you have a transfer mechanism at some point based on certain parameters. We're seeing that more and more in some of the deals, but assume going into it that it's forever. If you assume that, then you work out whatever discrepancies you might have during the deal-making process, and then you've got a good relationship going on forever. Be flexible, again, broken record kind of deal. Somebody, whether it's your public customers, the customers that get transferred to a private company, the private company, taxpayers, somebody's paying for infrastructure. There are no free rides here, right? It's either going to be taxes, public money, private money, whatever it is. So you got to keep that in mind. And again, open communication with your partner and also your customers, right? I think when you enter into a discussion with a private company, there has to be a certain level of transparency with your customers, and they have to understand why you're looking at that kind of thing. So again, just to reiterate it, infrastructure is everybody's issue, and yes, those are water mains. They did deliver drinking water at some point in their life. So, and I would venture to guess that if you have a water system that is has pipe from the 50s or 40s, you have pipe that looks like this. So infrastructure is everybody's issue. So Savannah, I'm ready for whatever questions we might have.
All right, Tom, are you ready for a question?
I'm ready.
All right. So an attendee asks, can you discuss approaches to prepare customers for a utility sale and private ownership that will likely raise rates significantly to recover true costs?
Okay, so I think again it's a big time communication. I think you need to explain if you're not recovering full cost of service today, there needs to be an explanation as to why you're not, and how that, for example, if the water fund is getting subsidized from your general fund, there might be one of the explanations might be, your water rates will go up, but this will allow us to potentially avoid a tax increase on the general fund. That's just an example. I'm not saying that's necessarily factual in all cases. I think there needs to be, there's a motivation factor for the utility that's selling. It might be that they don't have any more debt capacity, yet have a real need for investment in infrastructure, so they have to do that. They might be losing, small systems especially, you might be losing the operator that operated your plant, your facility for the last 50 years, and that person is retiring, and you see the need to spread that risk across a larger base and bring in a bigger company. I think it's sort of specific to each instance, but I think the key to it is being transparent and being honest as to why you're doing it, and also talk about, in some instances it might be funded pension liability, and you see a way of taking care of that through monetizing this asset. So each one's a little bit different, but again, I think transparency with your customers is important. And the other thing, whether you're the private utility or the public utility, and I used to tell the people that I worked with this all the time: don't promise something you can't deliver. Don't promise a rate reduction, or if it's not going to happen, or freezing of rates if that's not going to happen. I think your customers deserve, total transparency and honesty.
Thank you so much, Tom, for providing an in-depth look at the roles of private water and sewer companies. And thank you all to the attendees that joined us today. Tom, I'll throw it back to you if you have any additional closing comments.
No, just thank you for those that spent some time with us today, and keep an open mind when it comes to private systems, but challenge them if you decide to work with them. And if you have any questions, feel free to drop me an email.
All right. Have a wonderful afternoon, everyone.